Thanks for clicking. My name is Mark Mitchell. I'm a mortgage broker here in London, Ontario. This week, Bloomberg came out with a report showing that Canada's real estate market is highly susceptible to crash, and that it's revealing bubble indicators similar to that of the U.S. in 2008. While the report lists a number of indicators, which I do want to go through in a later video and compare them to the real estate market in London, Ontario, in this video I just wanted to do a brief overview of what actually caused the crash in 2008 and whether or not Canada's real estate, and more importantly its mortgage market, whether or not it resembles to what were the conditions that led to the 2008 crash in the United States. So what did lead to the crash in 2008 and the mortgage and real estate crisis? Well, let's let Ryan Gosling from The Big Short explain it to us.
I'm talking rock bottom FICO scores, no income verification, adjustable rates.
So those three indicators, rock bottom FICO scores, that's your credit score, no income verification, and adjustable rates. Well, those were not all the factors that led to the mortgage crisis. It's obviously much more complicated than that. For the purpose of this video, I just want to go through those three main indicators and see what it's actually like in Canada right now. First off, rock bottom FICO scores. That's your credit score. When he's saying rock bottom FICO scores, he's talking about subprime scores well below 600. Those scores mean there's the collections on the account, multiple missed credit card payments, serious delinquencies on your credit cards. In Canada right now, we can't have any of that to qualify for a mortgage with less than 20% down. So anything less than 20% is considered an insured mortgage. Minimum credit score for insured mortgage is 600. CMHC actually just recently changed their minimum credit score to 680. So in order to get a mortgage with less than 20% down in Canada, we definitely need to have a much higher credit score, especially than compared to the US in 2008. If you do have over 20% down, you can get a mortgage at a much higher interest rate. So you do have to show and we'll get into this, so you do have to show the income that you can still handle that carrying cost. But there has to be a large portion of equity put down in order to get a mortgage with a low credit score. So what that does is makes it so that if the bank does have to take the house back, they have 20% equity already in that house. So they don't have to worry that they won't be able to get their money out of the house should they have to sell it. So the bank won't undergo a capital crisis much like it did in the U.S. in 2008, which was one of the biggest reasons for the crash, was that the banks weren't able to sell their house for enough money and still get their money out of it. So on the one hand, we have our insured mortgages, which guarantee a much more creditworthy, a much higher credit rating to be able to get a mortgage under 20%. And on the other side, if there is more than 20% down, you can get a mortgage, but the banks maintain a large amount of equity in that house that has been purchased. So we can see just in the creditworthiness, Canada's requirements are much higher than they were in the US in 2008. Next up is the income verification. In the US in 2008, it was fairly standard practice for the mortgage lenders not to verify any income. These were called stated income loans. So you basically just told the banks how much you made, and they said, oh, okay, well that qualifies, and then you were provided with the mortgage. That's a little simplistic, but basically that's kind of how it worked. There was there wasn't much income verification. Two movies that you might have seen, The Big Short and Too Big to Fail, actually great movies going over the 2008 financial crisis. They actually go over this quite well. They talk about ninja loans, which was no income, no job, no assets, and you still get the mortgage. Contrast that with Canada right now, and actually our income verification is very, very stringent. The mortgage lenders want to see an employment letter, dated, and they want to see a recent pay stub. The lenders will call the employer to ensure that the pay stub and the letter of employment are accurate. If you're hourly, they want to see 2 years average T4s, so they want to see that your income is going to be consistent over time. Or if you're salary, they do want to see that they will call to verify that you do have that salary. And if you're guaranteed your hours, they want to see that it is guaranteed. So we see, like, compared to not having to verify anything in 2008, whereas right now in Canada, the lenders want to verify everything. So it's really not a situation similar to that in the States in 2008, where the lenders are just looking for reasons to give you money. They want to see that you qualify and that you'll be able to pay. Finally, adjustable rates. Adjustable rates in the States at the time were called also teaser rates. So that's where the mortgage lender gives you a 2% introductory rate, making you think you can afford the mortgage payments, and then later on when you can't, or later on you find out you can't because they get raised to say 8 or 9%. That caused a lot of borrowers to not be able to make their mortgage payments. Payment from 2% going up to 9%, that's going to more than quadruple your mortgage payment, which not very many people can handle that. Adjustable rates, we don't have that in Canada. We do, but the majority of lenders do not offer it. So when you go for a 5-year fixed, you're locked in at that 1.85%, 2%. And that's not going to change until your renewal date, which will be 5 years from now. And we also haven't, so interest rates can swing with prime at the time of your renewal rate, but as we've seen over the past 10, 15 years, we haven't seen massive swings, especially not rates that have quadrupled. As I mentioned in previous videos, it's probably unlikely we're going to see big swings like we did in the 80s or 90s, although it could still happen. But the point is that the adjustable rates that we saw in the U.S. pre-2008, that led to 2008, with people not being able to make their mortgage payments after it quadrupled, we are unlikely to see such a similar situation here in Canada. It's just we don't really have those adjustable rates that can cause such huge swings in your mortgage payments, unless you go variable, in which case most borrowers, most brokers, most banks will go over all the risks associated with variable rate mortgages. But that's kind of a caveat. That's not what they're talking about when they say that adjustable rates led to the 2008 crisis. So in conclusion, if we look at the credit scores requirements, income verification requirements, and our lack of adjustable rates, Canada's mortgage market and real estate market is much, much different than it was in the US in 2008. I think 2008 is obviously quite a bit more complicated than in this video, and even more complicated than listed in The Big Short or in a lot of the popular movies out there. There's been, dozens of books, if not hundreds of books, written about it. So it's obviously fairly complicated. But I think all too often people think of 2008 and they think the economy was bad and real estate popped and everything got way worse. And those sort of 3 factors are the only ones that are considered. And then it gets compared to now when the economy's not great due to COVID, but real estate went through the roof. And I think there's a big worry that we're on the precipice of another 2008. So I just think it's a good idea to look at what were the factors pre-2008 in the US and compare it to Canada's mortgage markets right now. Just to see that we have quite a bit more stability and a lot more protections involved just in case that the worst does happen. And we have those protections, including the stress test, which we haven't even talked about in this video, but we have in others. We also have the stress test. So we have a lot of backups, a lot of protections in place in Canada just to ensure that a crash such as 2008 does not happen here. Never say never, but there are protections in place. It's not a strict 1-to-1, 2008, 2021. The two are very, very different. If you like this video, please do click like and subscribe, and we'll have more updates as they come out. Especially, I want to do another video on this Bloomberg report and look at each one of those exact indicators that they have listed. Thank you.